$3 billion in silver just vanished from the market in less than 48 hours. Not slowly, not gradually, gone. And if you think this is just another market blip, you need to hear what happened next, because what we're seeing right now might be the warning shot before something much bigger breaks wide open. The charts are screaming, the insiders are moving, and the silence from mainstream media, that should terrify you more than anything else. Stay with me, because in the next few minutes I'm going to show you exactly what's happening, who's behind it, and why your financial future might depend on understanding this moment. Welcome to the Silent Collapse, where we break down the financial events that nobody else is talking about. And trust me, what you're about to discover is something they definitely don't want you to know. Before we dive deeper, if this kind of critical financial analysis matters to you, do me a favor and smash. Let's talk about what actually happened. 48 hours ago, institutional investors began pulling silver out of the market at a pace we haven't seen in years. We're not talking about retail investors buying a few coins here and there. This was coordinated. This was massive. $3 billion doesn't just move by accident. When money moves this fast, this deliberately, there's always a reason. And that reason is almost never good news for the average person watching from the sidelines. The first signs appeared in the futures market. Silver futures contracts started showing unusual activity. Large positions were being closed, settlement demands were spiking. Delivery requests were flooding in at rates that caught even seasoned traders off guard. Now, most people don't pay attention to futures markets. They seem complicated, technical, boring even. But here's what you need to understand. The futures market is where the big players make their moves before the rest of the world catches on. It's the early warning system. And right now, that system is flashing red. What makes this even more interesting is the timing. This didn't happen in a vacuum. Over the past several months, we've been watching a quiet but steady accumulation of physical silver by countries that most Americans don't think about every day. China has been stockpiling. Russia has been buying. Even smaller nations have been converting currency reserves into tangible assets. They've been preparing for something. And now suddenly, the institutional money is running for the exits at the exact same time. Coincidence? Not likely. Here's where it gets personal for you. Silver isn't just some abstract commodity that traders gamble on. It's deeply embedded in the real economy. Your smartphone, it needs silver. Solar panels that are supposed to save the planet, loaded with silver. Medical equipment, automotive electronics, defense systems, all of them depend on silver. When the price of silver moves dramatically, it doesn't just affect investors, it ripples through manufacturing costs, consumer prices, and ultimately your wallet. The $3 billion exit we're seeing isn't just a market event. It's a signal that something fundamental is shifting in the global economy. Now let's address the elephant in the room. Why silver? Why now? For decades, silver has lived in the shadow of gold. Gold gets all the headlines. Gold is what central banks hoard. Gold is what preppers bury in their backyards. But silver? Silver is different. It's the working man's precious metal. It's more volatile, more industrial, and in many ways, more critical to modern life than gold. And that's exactly why smart money pays attention when silver starts moving violently. The current silver market has a dirty little secret that most people don't know about. For years, the paper silver market, meaning futures contracts and derivatives, has been vastly larger than the physical silver market. Banks and institutions have been trading silver that doesn't actually exist in physical form. It's a paper game. And that game works fine until suddenly everyone wants to convert their paper claims into actual metal. Then the whole system seizes up. And based on what we're seeing in these delivery demands, that seizure might be starting right now. Take a moment and think about what happened with GameStop a few years back. Retail investors discovered that hedge funds had shorted more shares than actually existed. The squeeze that followed sent shockwaves through Wall Street. Now imagine that same dynamic. But instead of a video game retailer, we're talking about a critical industrial metal that the entire modern economy depends on. The potential for disruption is exponentially larger. And the people moving $3 billion out of silver in 48 hours, they know this. They're not panicking. They're positioning. If you're finding this information valuable, take 2 seconds right now and hit that like button. It genuinely helps us continue bringing you this analysis that you won't find on mainstream financial news. They're too busy talking about whatever stock split or celebrity investor tweet happened today. We're focused on what actually matters to your financial security. Let me walk you through exactly how this exit unfolded, because the details matter. It started quietly on a Tuesday morning. Silver prices were relatively stable, nothing unusual on the surface, but beneath that calm surface, large block trades were being executed. These weren't the normal flow of business. These were targeted, strategic exits. By Tuesday afternoon, the volume had increased noticeably. By Wednesday morning, it was undeniable. Something big was moving. The traders who pay attention to order flow, the ones who watch how the big institutions operate, they saw it immediately. The question wasn't whether something was happening. The question was why. Wednesday brought the first public signs. Silver prices started to slip. Not crash, not collapse, but a steady, purposeful decline. And here's the key detail that most people missed. While prices were declining, delivery requests were surging. Think about that for a second. Usually when prices, by Thursday, the exit had reached full speed. $3 billion doesn't move quietly, even when institutions try to be discreet. The order books told the story: large sellers, persistent pressure, and a clear direction: down. But again, physical demand remained strong. Coin dealers started reporting unusual buying activity. Refiners were getting calls from institutional buyers. The disconnect between the paper market and physical market was widening into a chasm. And that chasm? That's where fortunes are made and lost. Now, here's what the silent collapse has been tracking that nobody else is connecting. This silver exit is happening at the exact same time that we're seeing stress in other parts of the financial system. Corporate debt markets are shaky. Commercial real estate is teetering. Regional banks are still recovering from the crisis earlier this year that the media has conveniently forgotten about. When you zoom out and look at the whole picture, this silver movement isn't isolated. It's part of a larger repositioning by institutional money. They're moving out of risk assets and into tangible stores of value, and they're doing it quickly. Let us talk about the players involved, because knowing who's moving tells you as much as knowing what's moving. The major bullion banks, the ones who dominate precious metals trading, they've been on the sell side. Investment funds that normally hold silver as part of commodity baskets, they've been reducing exposure. But on the buy side, that's where it gets interesting. We're seeing sovereign wealth funds quietly accumulating. We're seeing family offices, the private investment arms of the ultra-wealthy, taking delivery. These aren't traders looking to flip for a quick profit. These are long-term strategic buyers who are planning for a very different future than what the talking heads on television are predicting. There's a pattern here that anyone who studies history should recognize. Before major financial disruptions, before currency crises, before the kind of economic earthquakes that redefine how wealth is distributed, you always see the same thing. The people with insider knowledge, with access to information the public doesn't have, they move first. They move quietly. And they move into assets that will hold value when the paper systems fail. Silver, throughout human history, has been exactly that kind of asset. It's money when money stops working. It's value when value becomes subjective. And right now, the people who understand this are loading up. Think about what we've learned just in the past few years. We learned that central banks can print unlimited amounts of currency without immediate consequences. We learned that governments can shut down entire economies and simply issue checks to make up for lost income. We learned that the rules we thought governed financial markets can be changed overnight when the people in power decide it is necessary. Given all of that, is it really surprising that institutional money is moving toward assets that can't be printed, can't be digitized, and can't be devalued by government decree? Silver is one of those assets. The smart money knows it. Let me share something that should make you uncomfortable. The global silver market is actually quite small compared to other financial markets. The entire annual silver production is only worth about $25 billion. Compare that to the bond market, which is measured in hundreds of trillions. Compare it to the stock market, valued in the dozens of trillions. Silver is tiny, which means it doesn't take much money, relatively speaking, to move the market dramatically. That $3 billion exit we're tracking? In the grand scheme of global finance, that's not huge. But in the silver market, it's massive. It's enough to signal a major shift in sentiment. And when sentiment shifts in small markets, prices can move violently and quickly. Here's what keeps me up at night. We're living through the early stages of a global monetary reset. Central banks around the world are experimenting with digital currencies. The dollar's dominance as the world reserve currency is being challenged more seriously than at any time since World War II. Nations are looking for alternatives, for hedges, for ways to preserve wealth outside the traditional dollar-based system. And in that environment, physical precious metals become extraordinarily important. They're the neutral ground. They're the asset that every nation, every culture, every economic system recognizes as valuable. When the music stops and everyone's scrambling for chairs, silver is one of those chairs. And there aren't enough of them to go around. If you're still watching, you're clearly serious about understanding what's really happening in the financial world. Go ahead and subscribe to The Silent Collapse right now, because this story is just getting started. We're going to be tracking every development, every data point, every move the institutional players make. You need to be informed. You need to see what's coming before it arrives. That's what we do here. That's why this channel exists. Now, let's talk about the immediate implications. What does this mean for you, sitting at home trying to navigate your own financial future? First, understand that when institutional money moves this decisively, retail investors usually find out too late. By the time something becomes obvious enough to make mainstream news, the opportunity has passed or the danger has already arrived. The fact that you're learning about this $3 billion exit now, while it's still unfolding, puts you ahead of 99% of people. Use that advantage. Second, recognize that silver's role in the industrial economy means this isn't just an investment story. If supply tightens, if the disconnect between paper and physical markets reaches a breaking point, we could see disruptions in manufacturing, in technology production, in green energy development. All of these sectors depend on steady, affordable access to silver. When that access is threatened, costs rise, and those costs get passed to consumers. That means inflation in the products you buy, the technology you depend on, the infrastructure being built around you. Third, consider what this tells us about institutional confidence in the broader financial system. These major players aren't exiting silver because they think everything is fine and they found something better. They're repositioning because they see risks that aren't being publicly discussed. Maybe it's concern about the banking system, maybe it's worry about government debt levels, maybe it's fear of currency debasement. Whatever the specific trigger, the message is clear. The smart money is getting defensive. And when elephants start running, mice should pay attention. Let me tell you about a conversation I had recently with a metals dealer who's been in the business for 30 years. He told me something that really stuck with me. He said that in all his years of trading, he's seen exactly two types of markets. Normal markets, where paper and physical move together, where supply and demand are balanced, where prices reflect rational expectations. And then there are crisis markets where everything breaks down, where physical disconnects from paper, where premiums explode, where you literally cannot buy metal at any price because nothing is available. He said we're transitioning from the first type of market to the second. And once that transition is complete, most people will wish they had paid attention sooner. The historical precedents for what we're seeing are not comforting. In the 1970s, when inflation raged and currency confidence collapsed, precious metals went parabolic. Silver went from around $2 an ounce to $50 in a matter of years. People who owned physical metal saw generational wealth creation. People who didn't got destroyed by inflation. In 2008, during the financial crisis, there was a brief moment when you simply could not buy silver coins or bars. The mints were sold out. Dealers had nothing. The physical market seized up even though paper prices were relatively low. Those who prepared in advance were fine. Those who waited until the crisis was obvious were locked out. We might be watching that pattern repeat right now, but on a much larger scale. The economic distortions created by years of zero interest rates, by unlimited money printing, by government intervention in every corner of the market, these distortions are massive, far bigger than what we saw in the 70s or in 2008. When they unwind, and they will unwind because they always do, the impact will be proportionally larger, and in that environment, the exodus we're seeing in silver right now won't look like an overreaction. It'll look like the early warning. The challenge for most people is that we're conditioned to trust the system. We're told that experts are in control, that problems will be managed, that crashes and crises are things from the past that modern policy tools have made obsolete. And for a long time, that narrative held. Central banks did step in, governments did stabilize things, markets did recover. But every intervention requires more intervention. Every bailout requires a bigger bailout. Every crisis resolution plants the seeds for the next, larger crisis. And we may be approaching the point where the tools that worked before simply don't work anymore. That's when precious metals stop being a quaint investment and become a survival necessity. Think about the average American's financial situation. Most wealth is in either real estate or retirement accounts filled with stocks and bonds. Both of those are paper assets in the sense that their value depends entirely on the continuation of the current financial system. If that system faces serious stress, if confidence breaks, if the dollar's purchasing power erodes significantly, those assets don't provide the protection people think they do. Real estate can be taxed, can be subject to capital controls, can lose value in local currency terms, even if it holds value in real terms. Stocks and bonds are just claims on future cash flows denominated in a currency that is being actively devalued. Physical silver, that's different. That's an asset that exists outside the system. And that difference matters more than most people realize. We're now seeing secondary effects of this silver exit that are worth noting. Mining companies that produce silver are seeing their stocks react. Some are down, which makes sense if people think silver demand is falling, but others are actually up, which suggests that informed investors think physical supply is going to become more valuable even as paper prices struggle. As we approach the end of this analysis, I want to leave you with a few final thoughts. First, trust your instincts. If something feels wrong about the current financial system, if the official explanations don't quite add up, if you sense that the people in charge are less confident than they pretend to be, you're probably right. $3 billion exiting silver in 48 hours is not normal. It's a warning sign. Treat it as such. Second, understand that you don't need to predict the exact future to prepare for it. You don't need to know whether the crisis comes in 6 months or 6 years. You just need to recognize that the current trajectory is unsustainable and position yourself for a range of possible outcomes. Diversification isn't about being right. It's about being protected when you're wrong, or when circumstances change in ways you didn't anticipate. Third, stay informed. This story is developing in real time. The institutions that move first are just the beginning. More will follow. Prices will react. New information will emerge. You need to be plugged into sources that are actually tracking this, not sources that are reading press releases and regurgitating official narratives. That's why channels like The Silent Collapse exist. We're here to cut through the noise and show you what matters. Before you go, make sure you're subscribed because we're going to be following this silver situation every step of the way. New developments are coming daily, the data is evolving, and you need to stay ahead of it. Also, drop a comment and let me know what you think is really going on here. Is this the beginning of a broader flight to safety? Is this institution's positioning for something they know is coming? Share your thoughts. Let's build a community of people who see what's really happening and are preparing accordingly. The $3 billion silver exit is not the story. It's a symptom, a data point, a piece of evidence in a much larger case. The real story is that the global financial system is under stress in ways that most people don't see or understand. The institution